Welcome to e-Adhyayan Commerce. Today we will talk about the accounting basics, that is the accounting assumptions, conventions and principles. These three combinedly is considered as the set of rules, underlying structure or the overall guideline to do accounting. These three are the foundation. Okay, these three are the foundation of doing accounting, or we can say that these three are the language of doing accounting. Now we will understand them one by one. Specifically in this video we will talk about the assumption and conventions of accounting. On a later video we will talk about the principles of accounting. So let's start for the day. Now we will talk about the definitions of accounting assumptions and accounting conventions. Now if we see the accounting assumptions, these are the basic unwritten presumptions that are automatically followed when we are doing accounting. That is, we automatically or by default presume that the business is a going concern. Okay, we presume that we are following the accrual basis of accounting. Also that we utilize or we presume that we are being consistent about our accounting. Okay, we will talk about them in brief in this video. Next, it is the accounting conventions. Accounting conventions are practical, traditional customs and guidelines that are followed for financial reporting. Okay, the conventions of accounting that we follow is that full disclosure of the informations, okay, consistency of methodology, the theory of prudence and materiality. So we will talk about those specific assumptions and convention in detail as well. Now we will talk about the accounting assumptions one by one. The first one is going concern. It says that the business will continue for a foreseeable future with no intention of liquidating. Now it says there is a term here that is foreseeable future. It is saying that the business will continue for a foreseeable future. Foreseeable future means 12 months from the last reporting date, that we are financially reporting about the state of the entire business at a particular day. So from that day 12 months onwards the business will be in operation with no intention of liquidating, that is with no intention of shutdown or stopping the operations of the business. Okay, so this goes our first assumption. Next one, consistency. It says that the business will operate indefinitely, recording events truly and fairly. Here truly and fairly means that we will be transparent about the financial events that are taking place in the business, that we will record accordingly, that will show the true and fair picture of the business, that we will not be taking any unfair means while showing the business transactions. And the third part is accrual. The third one says transactions are recorded as per their occurrence, regardless of when actual cash is paid or received. It is very important to understand this. It actually means that the revenue should be recognized when it is being earned, not when the actual cash is received. In the same way, the expense should be accounted in the relevant period, not when it is being actually paid. Now we will take an example to understand it. Okay, let's say A Limited is selling a laptop to B Limited. Okay, so they are now the price is rupees 20,000. Okay, now A Limited has sold the laptop to B Limited on 31st of March 2026, but B Limited has actually paid after 12 AM. Okay, so the payment date would be 1st of April 2026. Now you see that for A Limited, since they have made the sales and received the cash, that is rupees 20,000, they should account for this date, 31st of March 2026. So it should be shown in the sales book of 2025-2026, not 2026-2027. Okay, because if we take this date, the entire financial year changes from 2025-26 to 2026-27. So we should obviously account for this date, the date when the revenue should have been actually recognized, not when the actual cash is received. Okay, in the same way for B Limited, they should also show that in their purchase book that they have bought the laptop on 31st of March 2026, that is in a financial year of 2025-2026. That means that when the expense should have occurred, that is in the relevant period, not when the actual cash is paid. Okay, so this is a small yet powerful understanding of accrual basis. Now we will move on to the accounting conventions. Now we will talk about the accounting conventions. The first one is full disclosure. It says that sufficient disclosure of all information related to the financial and economic affairs of the business through notes of accounts. So it states that all the relevant information needs to be disclosed through the notes of accounts, which will show the true and fair view of the organization, because that will state the financial and economic affairs in a true and fair way, that we will be following the transparency, that whatever is the actual picture of the financial or economic state of the organization will be demonstrated. Okay, so we can say that full disclosure means true and fair view of the organization. Okay, the next one is conservatism or prudence. It states that all anticipatory losses are to be recorded, but anticipatory profits are to be ignored. Say we know that there are some debtors who will not pay back to us, so we create a provision for bad debt, that we are expecting that we will not be getting back a certain amount of money from some debtors. So we always account for that. But if there is an anticipatory profit, we don't account for that. We don't show that in our books. The example that I have actually provided is that is the provision of bad debt. Okay, it is called the theory of playing safe, as we are showing all anticipatory losses. It will rather show a less value of our organization, but not an unfair inflated value by showing the anticipatory profits. So I'm going to write here theory of playing safe. Okay, theory of playing safe. The third one is materiality. It states that the insignificant details can be filtered out and required not to be disclosed. Insignificant means the small and irrelevant details. Okay, I'm going to highlight this. Insignificant, that is small and irrelevant details. Okay, an example would be that if we are buying a pen, okay, a pen will cost 3 or 4 rupees, a use and throw pen, but we are accounting for crores and crores of rupees in a financial year. So that is insignificant, right? Buying a single pen in front of accounting of crores of rupees will be definitely insignificant. So it has been advised to us that if we want, we can filter it out and it is required not to be disclosed. Okay, so in example I am writing buying a pen and filtering out that transaction. Okay, now the fourth and last point is consistency. It states that applying the same methodology and standards over different periods. Okay, I'm highlighting methodology. It is saying that we should be applying the same methods and standards over different accounting periods. Now let's take an example. Say we account for depreciation. Okay, now in the financial year 2025-2026, if our method of depreciation is straight line method, then in the accounting year 2026-2027 we should be using the same method on that year also, that over the different accounting periods we are using the same methods. Okay, so I'm writing the example here. Using straight line method as depreciating method. Okay, that we are using the same method over different accounting periods. So I am writing here same methods. So this is a broad idea about accounting conventions. In this video, we have discussed about the foundations of accounting, that is the accounting conventions and accounting assumptions. In the very next video, we will be talking about another foundation of accounting, that is accounting principles. I hope I have helped you understand today's topics in a brief and simple way. I hope to meet you in the next video. Thank you.